Hello, and welcome to Portfolio Matters Share Talk. And in today's short Share Talk, we will be getting back to our core expertise, which is dodgy oil service companies. And we will be covering the highly indebted turnaround situation, Gulf Marine Services. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, I very nearly inserted the word dodgy in the disclaimer, but I resisted the temptation.
Very good. Right. Let's get on with it. Okay. Gulf Marine Services is an operator of self-propelled lift boats listed in London. We'll show you some videos of how these things work, but basically they sail along and then these four pylons at the corners can be jacked down to lift the boat out of the water, and it becomes a rig essentially. Okay, share price is currently 5.5p, having come down a long way, and market cap of 54 million, debts of 379 million. All of it is bank debt. Revenue last year, 78 million. So PE ratio, forecast PE ratio 3.2. Okay, so this is a high risk turnaround situation. Essentially what happened is that back in 2015, 2016, Gulf Marine Services invested in enlarging the fleet and they took on debt to do so. But sadly, the market then turned down and the revenues they had in 2016 have never been matched. So both the utilization rate and the day rates for these self-elevating support vessels have collapsed since then. And last year, there was a crisis in which the company very, very nearly went bust, basically, and ended up in the control of the banks, but there's new management. We will go through all this. So the debts of 380 million dwarf the share capital. And last year, essentially, there was a whole change in the management. The previous management had made an agreement with the banks in which they would start paying interest through payment in kind and warrants, which would be highly dilutive to shareholders. Some Middle Eastern investment firms took stakes in Gulf Marine Services, made a putative bid, which kind of never went anywhere, and then arranged the ousting of the former management. And they have renegotiated the covenants on all the bank debt and reduced the interest on the bank debt from LIBOR plus 5% to LIBOR plus 3%, got rid of the warrants, got rid of the payment in kind, all of which is fantastic news. And it makes you think that these Middle Eastern investors who are now in control of the company and have provided the chairman, CEO, that's one man is chairman and CEO, have good connections in the Middle East. And frankly, you need to have those links to the banks to ensure the survival of this very heavily indebted company. Now, in the last year, obviously the oil price has turned up. Utilization rate for these self-elevated support vessels has risen strongly, and the last trading update was very good. It showed rising utilization rates and rising day rates. Now, those two are linked. As the utilization rate hits 100%, so if you want one of these, you're going to have to outbid the other people who also want them. And obviously, during the downturn, nobody has invested in new self-elevating support vessels or any other oil support service stuff, frankly. So if we get a lift in CapEx in the Middle East, where the majority of these vessels are now located, then you should see very strong uplifts in the revenues of Gulf Marine Services, because the day rates are still a long way below where they were back in 2016. And we calculate that it's on a forward PE ratio of 2.9. And Paul Scott of Stockopedia has been recommending the shares. Now, I have a long-standing investment in this, and I added to it when in the recent placing at 3p. Now, the biggest problem is that by the end of next year, the company needs to raise a further $50 million of share capital equity in order to meet its agreement with the banks. If it fails to raise that 50 million, then payment in kind and warrants will return for the banks, and it'll breach all sorts of covenants. Not good. So that's the big overhang, the big risk. Okay. This is the sad and sorry tale of Gulf Marine Services. Way back in 2015, when it had just listed and the oil market was doing okay, share price was over £1. It had bottomed at 3p. It's now 5p, 5.5p. Okay, so what does it do? So on the left is a self-elevating support vessel, as owned by Gulf Marine Services, and on the right is a traditional jackup rig. At the bottom is the cost of the operation, and you'll see the self-elevating support vessel is faster and cheaper at doing these well interventions than is a traditional jackup. You see it. So on the left, you'll see the 4 pylons being driven down into the seabed, and the vessel will now lift out of the water. Then you have the essentially rig equipment comes out of on this cantilever, and you're done. So total cost of the operation using a self-elevated support vessel is $110,000. Using a jackup, the jackup is still going, and to do the same operation is going to be $405,000. So they have various classes of self-elevating support vessels for hire. There are 4 of the largest type, the E-class, which have the cantilever systems, which we've just shown you, and accommodation blocks. And in 2020, those had a 65% utilization rate, and I estimate their day rate was about $31,000 a day. Now, the big ones have the lowest utilization rate, sadly. Then you then have the S-class. There are 3 of those. They had a 92% utilization rate and a $32,000 a day rate. Now you notice that's higher because essentially the utilization rate's higher. Higher the utilization rate, the more you have to bid up to get hold of one, basically. Okay, so this is what an S-class looks like when it's jacked up on land. I mean, pylons lift the vessels a long way out of the water, off the seabed, I mean. And during the downturn, Gulf Marine Services reorientated a lot of the business towards renewables and moved 3 vessels to UK waters to work on the offshore wind sector. Now they have sent 2 of those back to the Middle East, where presumably rates are higher. And the smallest ones are the K class. They had 86% utilization rate last year, and I estimate their day rate about 22K per day. And this is what happened last year. So you'll see there were 3 vessels operating in the UK, one having moved from Germany, and during the year 2 of those moved back to the Middle East, to the UAE. And we can find out where the Endeavour is thanks to this website that shows the positions of every vessel in the world. And as of the 20th November, it was offshore UK. Okay, so the annual report helpfully provides a breakdown of the revenues by each vessel class, and essentially the large E classes lost money last year. So the utilization rates, as we saw, they don't command a higher price than the S class because their utilization rates are lower, so you don't have to bid up for them. There were enough of them. Now, the S-class utilization rates were low in 2020 due to the need to take 2 vessels out of service for maintenance. But as you can see, the S-class was decently profitable. And the E-class day rates were lower because essentially nobody needed the bigger vessels, and they ended up doing contracts which could have been done by the Cave class vessels, which are much smaller. So in 2020, the company impaired the value of the K and E class vessels by 87.2 million, which were depressed earnings. And frankly, that was the latest in a run of impairments in recent annual reports, as the day rates and profits have been much lower than anticipated, and vastly lower than was anticipated when the fleet was expanded back in 2016. Okay, so let's go through the share price history, which is sad. Okay, I'm going to rush through this because there is a hell of a lot to get through. Okay, so it's launched, its IPO was back in 2014, and then when it was already quite indebted. It had net debt of 180 million back in August 2014, a bank debt of 264 million. Then in November 2014, the interim management statement says that its new build program will be funded by borrowings and will aim to increase the fleet size by 66% by 2016. So they've got a secured order backlog at that stage of 547 million. So back in 2014, they've got a big order backlog, and they expect that to continue into the future. So they're going to increase bank or borrowings in order to expand the fleet. So moving forward, in May 2016, you have a utilization rate of 93%. Net debt is 409 million. 2017, bear in mind the shares have already collapsed by 60% at this stage. Long-term improving market, net secured order backlog in July 2016 was 258 million, i.e. much lower than it had been 2 years previously. Moving it forward to 2017, utilization rate only 56%. And then August 2017, profits warning due to delays in contracts and commencement dates. And that causes a big sell-off in the share price. Then in December 2019, it warns that delays in contract awards and commencements of contracts will cause it to breach its bank covenants. Shares fall by 75% to roughly where they are now. But a lot happens between then and now. Okay, so in January 2019, it amends banking covenants. Then in January 2019, CFOX International builds up a 13.7% stake and requisitions an extraordinary general meeting to demand the board be replaced. Ithmar Capital Partners joins them. But then in March, Ithmar and CFOX fail in their attempt to place their nominees on the board. And results for 2018 are a loss of 5.1 million due to an increase in bank charges. Trading update in May 2019, net debt 400 million. August 2019, another profits warning and the resignation of the CEO, Duncan Anderson. And frankly, he has overseen a massive destruction of shareholder value. September 2019, results delayed as Government Services attempts to secure crucial banking arrangements. Essentially, it needs a banking facility in order to fund working capital, and there is material uncertainty as to whether it's a going concern. Then it secures that facility later in the month. Then in February 2020, it agrees a further rollover its 25 million working capital facility and is in active dialogue with its lenders on a long-term solution to its capital structure, all of which is very bad for shareholders. And at that stage, management were very much talking about having to rearrange the capital structure to the detriment of shareholders. Then in April 2020, CFOX International announces it made a non-binding offer for the company at 9 cents a share, which the board rejects. On the 6th of May, CFOX announces it purchased 9.4 million shares at 10p, but made a no increase statement to the London Stock Exchange so that it can't raise its bid above 10p. Now, bear in mind that the share price is currently 5.5p after shareholders have put in a low 25 million of new capital. So, a 10p exit at this stage, I think, would have been welcomed by most shareholders, but was rejected by the board. Then later in May, Government Services announces that essentially it's got enough shareholders to reject the 10p takeover offer, and CFOX announces that it will not make a firm offer because it has no chance of success. In June 2020, the company announced a new capital structure involving a 50 million working capital facility secured until 2025, which is great news. And then in October 2020, the CFOX appointed directors resigned from the board, and CFOX votes against the issuing of warrants to participating banks. And the board is defeated in the resolution. And then in November 2020, an extraordinary general meeting called by CFOX, it succeeds in appointing its own representatives to the board. Then CEO Tim Summers is suspended. And CFOX appoints chairman Mansour Al-Alami to take over as the CEO. So essentially, CFOX have now appointed their man, Mansour Al-Alami, to be both chairman and CEO. And when CFOX secured the votes against the then agreement with the banks involving the issue of warrants and PIK, payment in kind, the Bank of America Securities and Canaccord resigned as joint brokers. So this company is in big trouble. It's in crisis. And then 1st of December 2020, Panmure Gordon is appointed corporate broker. Okay, so this is the agreement which caused all the problem. If you're interested, stop the video and read this in full. But this is the agreement that caused a lot of the problems. And the key clause here was that the company needed to raise at least 75 million of equity capital by the 31st of December 2020. If they failed to do that, then payment in kind interest and contingent warrants would be payable to the banks. And given the state of the company and frankly, the state of the market at that stage, the chance of raising 75 million was very low. And this agreement precipitated the crisis and CFOX and Ithmar partners essentially taking control of the company and replacing the management. Okay, so moving into this year, under the new management, who are Middle East based, they have renegotiated with the banks. And on the 16th of March, they announced a new agreement with the banks. And the interest payable on the loans was reduced from LIBOR plus 5% to LIBOR plus 3%. The previous agreement was cancelled, including the PIK and the warrants. As long as the company raised 25 million in new equity by the end of 2021, which they have done, and a further 50 million by December 2022, which they have not yet done. And in June 2021, they raised 20 million by a share placing at 3p, which I participated in. And now the share price is 5.5p roughly. That has been a good investment. But the danger is, if they do this again, having to raise $50 million, then you could see the share price once again take a huge hit if the placing is done at a discount. Okay, so this is their latest presentation. It's a relatively young fleet. So E-class, an average age of 8 years, mid-class 5 years, small K-class 14 years. So you don't really need that much ongoing maintenance because these are relatively new vessels. And nobody's been investing in new vessels during the oil downturn. So if oil capex picks up, hopefully you get an increase in utilization and day rates. This is the summary for this year. Now, notice that they have successively ground down G&A to, so there's 4.9 million in the first half 2021, down 26% on the year. But of course, EBITDA is not the metric we're really interested in for this company because it's got so much debt and interest is a huge expense for the company. The net debt has been reduced to 376 million. Okay, so utilization rates. Well, the problem is the big E-class vessels, which should have the highest day rates, they have the lowest utilization rates. And so they are not getting the day rates they deserve. The S-class vessels have high utilization rates, and therefore people have to bid up for them. And the S-class has higher day rates than the E-class. So this is as of the 30th of June. And you can see that the utilization rates for 2021 were very good, particularly for the smaller vessels. The E-class, not so good. And actually, bookings for the E-class, there's only one has been secured for 2022. And if we look at the long-term accounts for the company, you will see that there's been a big decrease in overheads, and you wonder how much lower this can go. It seems they're really running this in order to try and squeeze as much profits as they can, cutting down on everything else in order to pay the interest. Now, the good news is that they rent out most of their vessels to national oil companies who tend to charter for years at a time. So if there is an upturn in the industry and utilization rates approach 100%, you would hope that national oil companies will start bidding up and trying to secure these vessels for years into the future, in which case you have very good revenue visibility. Now, when they renegotiated the bank deal in March 2021, they delayed the need to raise the 75 million in equity, which should have been in the original agreement, had to have been done by the end of 2021. Under the new agreement, only 25 million needs to be done before the end of 2021. The other 50 need to be done by the end of 2022. And they raised the possibility that they would find other forms of financing to reduce the bank debt, and hence the second equity raising may not be necessary. Now, so far, we have heard nothing on that front, but there's a possibility that they could avoid doing the second $50 million raise, which would be great for shareholders. Okay, so bank borrowings. Now, it doesn't have any bonds, I believe. It's all bank debt. So, term loans within 1 year, you see, you've got 375 million secured until 2025. Those loans were at LIBOR plus 3%, down from LIBOR plus 5%, which has been negotiated by the new management and is an unalloyed good for shareholders and for the survival of the company. Now, the working capital facility is secured by a mortgage on the fleet. Okay, recent contract awards. So they do check out RNS statements showing new contract awards. On the 11th of November, 2 contract extensions for K and S-class vessel. On 21st of October, new 12-month contract for an E-class vessel commencing December 2021, 2-year extension for an S-class vessel. Management believes that 2022 will see a tightening market with increased demand. And frankly, if you're interested in this company, you have to believe that. So to reiterate, this market has self-reinforcing price dynamics. When demand increases, the utilization rate increases, and as it does so, you have to bid up for vessels, and the day rates also increase. The trouble is that works also the other way around. So as demand drops, the utilization rate falls and the day rates fall. And that has been Gulf Marine Services' problem over the last 5 years. So this new board, this is Mansour Al-Alami, who is the executive chairman. So chairman and CEO currently. This is the deputy chairman and non-executive director, and he is the chairman of Seafox International. So essentially, they're all Middle Eastern gentlemen who have been appointed by Seafox and Itmar, as opposed to the original management team who were British. But they have the contacts with banks in the Middle East, so that's good. And frankly, the situation has stabilized and improved since they have come in. Lord St. John of Bletsoe is a non-executive director. The management team, it's our man, Mansour Al-Alami. Okay, so who owns the company? Well, Seafox, Mazrui Investments. So this is a problem in that biggest shareholders are in control of this company, and you have to hope that they are running it for the benefit of the wider shareholder base and not just themselves. A chairman who is also CEO is frowned upon because there's nobody to stop him, to hold him to account, and to ensure that he's working for the benefit of all investors rather than just himself and his backers. Okay, so let's move on to calculation. Okay, corporate tax rates. Well, the UAE, where they have most of their ships, has a 0% corporate tax rate. And I estimate blended corporate tax rate for the company should be about 5.6%, but the actual tax rate in 2021 was 9.1%, which is still very low. So we will use 9.1%. We'll assume cost inflation at 5%. Utilization in 2020 was 81%, and we're not going to assume an increase in utilization rates. But bear in mind, in 2015, the utilization rate was 98%, i.e. they were fully utilized apart from the few days they had to move between contracts. In 2020, the average day rate was $27,000, and we are going to assume an increase in day rates of 5%. Non-controlling interests are 3.1%. Okay, so you're doing all that. You get a cash flow, profit attributable to shareholders of 14.7 million. Financing costs are 12.5 million. The returns of this company are being split evenly between the banks and the shareholders, but bear in mind they've got 360 million of debt. So are they going to be able to pay that off with the cash flow? Now, that includes depreciation and amortization of 31 million. So the net cash flow is around 46 million. But you have an implied PE ratio of 5.6. But they've recently updated their forecasts. And their forecast for the full year 2021 was in the region of 63 to 67 million. And in the first half, it was only 26.5 million. So that implies EBITDA in the second half between 36.5 and 40.5 million, i.e. a big uplift on the first half. And they've also said that the utilization rate in H2 will be 92%. So backing all that out, that implies an increase in day rates of 7.5% in H2. So let's redo those numbers, assuming a 10% increase in the day rate and a 92% utilization for 2022. Now, if we do that, it looks much better. The implied PE ratio is 2.9. Cash flow yield 72%, and you're kicking off a lot of cash, which you can use to pay down debt. And frankly, that also means the company looks much more attractive to potential lenders. So reducing the requirement, well, reducing the likelihood that I have to raise further debt. Okay, so this is historic revenues, and you'll see 2019 and 2020 came at a very bad time for Gulf Marine Services, the downturn in the oil market, and they recorded enormous losses, mainly due to impairments. Okay, onto positives and negatives. Well, they've got a new management team who have renegotiated the banking arrangements, cut interest rates, and frankly, turned around this company in that under the previous management, the guidance was very much that the capital structure was inappropriate and they were essentially preparing investors to be hugely diluted. Now, the new management team are making a fighting go of it, and the fact they've managed to cut the interest rate, I think, is a very positive sign. Okay, so they managed to cut the G&A costs from 17.8 million in 2019 to 12.6 in 2020. It's very good. And nobody has been investing in self-elevating support vessels, in part because they've been so unprofitable the last few years. And there is competition for the use of these vessels from offshore wind. So some of their competitors have moved vessels to China and to Europe to work in the offshore wind sector. There's a rising oil price, which should eventually lead to rising capex and hopefully rising utilization and day rate. and their latest RNS was evidence of that. Rising utilization of 92% in H2, an implied increase in day rates of 7.5%. The EBITDA will uncertainly rise in 2022 due to a lack of restructuring costs, which were mainly payments to the banks of 16.2 million in 2020, plus reduced interest costs, plus cost cutting. And as we saw, there's no corporation tax in the UAE. With this relatively new fleet, which requires little capex maintenance. And our calculation puts the shares on a PE ratio of 2.9 if the utilization and day rates seen in H2 2021 are continued into 2022. The negatives, well, it's enormously indebted, 386 million of debt for a company that has lost money in the last 2 years. Its debt to EBITDA ratio in H1 was over 7, and it needs to raise 50 million in new equity by the end of December 2022 to honor its agreements with the banks. If it doesn't, then it breaches covenants and all sorts of nasty things happen. Now, the management are holding out the possibility that there could be other forms of financing. But if they have to go with an equity raise, you will be diluted and you'll have to stump up more capital. And previously, the last equity raise was done at over a 50% discount to the share price. So, a further equity raise could be very bad for shareholders. And Seafox and Masruri Investments are related parties that between them own 36% of the company. And who is, Mansour Al-Alami is the chairman and the CEO. Not great. Who's going to hold him to account? This is almost entirely an oil services company now. So you've seen that in the last couple of years, it had been diverting vessels to Europe to work in onshore wind, and it's diverted 2 of the 3 back to the Middle East to work in the oil sector. And frankly, this company has a terrible history of shareholder value destruction. Now, in summary, I own these shares. And I put in some more capital in the placing at 3p. And if you believe that oil capex is going to return, utilization rates and day rates will rise, and this is very highly geared to an upturn in the market. But if they have to raise a further 50 million, and well, you can see that further stress, if there's a downturn in the market, this could disappear in a puff of smoke. You could have governance problems, financing problems, and the banks taking control of this company. Richard, your thoughts?
Yeah, thank you very much, Keith. It's very interesting. You've done a very detailed analysis as ever. I don't like this company. I wouldn't invest in it. I think that you have to take into account the uncertainties that are related to it, which are what will happen to the oil price. And we've discussed this many times in our weekly podcast, and we have a view that fossil fuels are going to be around for a lot longer than the ESG group would like them anticipate or claim they will be. But there is still considerable uncertainty about what's going to happen to the oil price. Then you add on to that the uncertainty is as to when a capital expenditure in oil services will pick up. You add on to that the uncertainty over whether if it does pick up, it'll be offshore or onshore oil. So then you take the vast quantity of debt that this business has got, and there's a big assumption that the vessels have got a 40-year life, and the oldest of them are in the mid-teens, and that the technology is still valid, that the maintenance costs are low, which I'm not sure I'd buy. There is the okay, so if they raise 50 million, then effectively assuming there's no dilution, then the market cap becomes 100 million, and your whatever the prospective PE is doubles, because current market cap is 50. And I just think there's the upside is that everything has to be perfect for it to, because of the level of debt, everything has to be perfect. And even if everything is perfect, what's the lifespan of oil services in offshore oil servicing? I don't know. And how long does a lifespan have to be for this company actually to pay back the cost of purchasing the shares? I don't know. So for all of those reasons, I don't like it. I'm sorry.
No, that is very very sensible analysis, Richard.
Thank you. I mean, having said that, it's the kiss of this means that over the course of the next few years, it'll be a 10-bagger, undoubtedly.
Well, the thing is, there's risk reward. And I mean, I'm not saying that anyone should have this as a sizable proportion of their portfolio. This is very high risk. Yeah. But the new management have come in and they've renegotiated the banking covenants and given this the prospect of survival. And day rates are certainly improving, as are utilization rates. And as long as that continues, they're kicking off a lot of cash flow and they can start repaying debt, actually quite substantially.
Yeah.
But they would have to divert 100% of cash flow to repaying bank debt for years to make a decent dent in it.
Exactly. And that's one of my big concerns. It is absurdly indebted. I mean, it's like the mind boggles at how they managed to raise that much debt.
Yeah.
Anyway, they are where they are, and that, I think, without that huge indebtedness hanging over them, and if they get rid of it, I mean, if you just do a little thought experiment, say, okay, well, supposing that they swapped debt for equity, and then their market cap went up to 350 million, having just thought experimentally, swapping debt for equity. What would the PE then be? Well, it would be like seven times what it is now, so it would be 14. And then in order to grow that business, everything has to go right in terms of utilization rates and prices, which, as we know, as we discussed, is dependent upon projections for the oil market and so forth. But I agree with you. You put a small amount in it at a punt, it could be worthwhile, or you could lose it. Yes,
you could lose it. The other thing is, what happens if the oil market turns down? I think then this company is in deep trouble, frankly. You'd need to raise 50 million. What would our shareholders' appetite be for putting more money into a failing business? Don't know. If they fail to raise the 50 million, then it ends up in control of the banks. Shareholders could well get wiped out.
Yeah.
So you're basically gambling that the oil market will continue strong. And frankly, I am. So on that basis, I have a small position in this, which I have added to at 3p. Thank you very much. And it's worked out so far. So, but I will be continuing. I won't be adding to it currently, but a lot will depend on news flow. If you continue to get good news flow, I think these shares will be all right.
Yes, I agree. Well, fingers crossed, Keith. I hope your investment turns out well.
Yes, right. Anyway. Okay, so that's it. If you are new to the channel, then our main output is actually the weekly update of market and macroeconomic news, and I hope you'll check one of those out. In the meantime, please can you press like and subscribe to the channel, and it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.